Hello, my name is Kevin McCulley. I'm a senior advisor with Private Capital Management. We're making these quarterly videos to educate you and to let you know how we're navigating today's market environment. In this quarter, we've noticed that recession risks are rising, yet key parts of our economy retain positive momentum. Really, the theme in general this year, with the Federal Reserve watching data and figuring out what to do with policy rates, is essentially, what's going to roll over first? Is it going to be growth due to tighter financial conditions, or will inflation start to trend lower, essentially from higher year-over-year comps and the fact that tighter financial conditions are getting people to actually spend less money? So at a really fundamental level, what the Fed's trying to do is they're trying to tighten financial conditions. They're trying to make it more expensive to borrow. In theory, that will reduce consumption, reduce demand, and it should reduce inflationary pressures on our economy. Looking at deals, for example, that made more sense when you could borrow at 3%, maybe don't look so exciting if you can borrow at 7%. What's really interesting about the environment today is that credit spreads are still quite low by historical standards. So credit spreads essentially measure how much risk the people perceive to be in the markets. Anytime you look at previous periods of market stress, like 2008 global financial crisis or the COVID crisis, you see credit spreads widen significantly, and we're just not there yet. So it's a little bit sort of mixed signals when you look at equity markets being down 25%, credit spreads for investment grade bonds staying below 200 basis points. Basically, the bond market and the equity market are telling you two different things. If the year were to end today, 2022 would be the worst year for investment grade bond performance going back over 100 years. Really the reason for that, we came off an artificially low interest rate environment, and coming from that into an environment with a significant amount of inflationary concerns, kind of a 1-2 punch for fixed income. Rates have come up. Most bonds are fixed rate bonds, meaning when rates go up, the price declines. However, today, bonds are looking much more attractive now, say over the next 5 to 10 years, than they've looked over the past 10 years. You're starting to be able to earn a decent amount of yield from fixed income, and certainly an amount of return that'll look more similar to maybe 20 years ago than where we were over the past couple of years. Historically speaking, bonds have been a very, very good diversifier from equities. They've had negative correlations. That has not been the case this year. Stocks and bonds now have positive correlation, so we need to look to incorporate other types of lower risk strategies that are actually going to help diversify portfolios. One other part of the bond market that's attractive to most high net worth and taxable investors right now is municipal bonds. Municipalities have had strong tax revenues, people continue to spend, and yet the yields on municipal bonds have gone up significantly along with the rest of the fixed income curve. Fixed income returns have been challenged at the same time that stock returns have been challenged. So a traditional 60-40 US portfolio is down just over 20% year to date through the end of the quarter, which would go down as one of the worst first 3 quarters of the year performance, again, going back nearly 100 years. I think you have a whole generation of investors, consumers, business leaders that don't really know how to operate in an environment with higher interest rates. Call it the last 3-4 years outside of COVID, investors maybe got a little complacent and we hadn't seen a whole lot of volatility. We've seen corporations, some big names announce layoffs, mostly in the technology space, software space. That could be for a number of reasons. Some of the big tech firms are cutting back on hiring, I think, is they're feeling some pressure from an earnings standpoint to essentially cut costs, to meet earnings, essentially guide future earnings to a level that shareholders will appreciate. And so one good way to do that, of course, would be to trim back hiring plans. There's still a record number of, again, I mentioned this earlier, a record number of job openings for job seekers. I think it's around 1.7 available jobs per job seeker. That number still is very, very strong relative to historical standards. There's still a lot of positive momentum in our economy, meaning a lot of our GDP comes from service-related industries, and so we may be seeing some weakness in areas like housing, but the fact that, again, our economy is diversified, a lot of services-based industries are still doing really well, is a good sign. This quarter's earnings will be very helpful to determine the general trend of the economy, trend of inflation, trend of consumer spending, and it should give investors a really good sense of how high we anticipate the Federal Reserve is going to have to raise rates. We understand these are challenging times. Inflation's high, there's a lot of uncertainty. Stocks and bonds are both down. However, we would like to remind you that we've been here before, and our economy has persevered. We've lived through steep stock drawdowns, bond performance similar to this in the 70s, and our economy has overcome these challenges. We have your back at PCM. We continue to follow the markets. We encourage you to stay diversified, stay invested. Remember, it's about time in the market, not timing the market. If you've enjoyed these videos, please share them and let your PCM advisor know so we can continue making them in the future. Thank you.